You've started investing for the first time, or maybe you're a seasoned investor. Maybe you're even the Wolf of Wall Street. No matter who you are, every investor, including Warren Buffett, who likes to read the entire annual report, even he needs to look at financial ratios. We have identified the following 10 best financial ratios that you should use before considering the purchase of any stock. If you haven't already, please subscribe to the channel and leave a thumbs up if you like financial ratios. Coming in at number 10, the operating margin, which is calculated as operating income over sales. This ratio tells an investor how much brand power and efficiency a company has. Walmart, who sells other companies' products, has a low ratio. And Apple, whose customers wait in lines for its product, has a higher ratio. However, a business can be very successful with high margins, such as Apple at 27%, or low margins, such as Walmart with 4.2%. But investors need to understand that these companies that are closer to zero can more easily drop into operating losses, which is why this ratio is so important, because these lower companies have more risk. Let's look at an example for Apple. Operating margin is calculated as operating income divided by sales. The number was a healthy 27%, indicating Apple can sell its products and invest in future growth and still have superior margins. This high number is even more impressive when we consider Apple sells a lot of hardware. As an investor, you should feel confident with these margins. Before we move to the next ratio, you might want to consider that before investing in a stock, you want to consider the level of financial distress a company may have. This is why you should look at ratio number 9. The interest coverage ratio is a good ratio to use to check for bankruptcy risk. Consider what Uncle Warren Buffett said. Over the years, a number of very smart people have learned the hard way that a long string of impressive numbers multiplied by a single zero always equals zero. What Uncle Buffett means by this is, if you lose all your money because your stock goes bankrupt, then you can lose all your money. EBIT means the same thing as operating income, but of course you knew that. Let's do an example to see how it's calculated and see Apple's financial risk. Apple's interest coverage ratio was over 20 times, meaning it can pay its interest expense by over 20 times over. Wow, this is an amazing number. This ratio helps you sleep at night, knowing that you won't wake up tomorrow with creditors knocking on your door. Number 8 is the second financial distress ratio, debt to equity. As an investor, you need to consider how levered the company is. The more liabilities relative to equity means that your company is taking on more risk, all things being equal. While number 9 on our list is great to show immediate danger, a high amount of leverage can indicate problems down the road. For example, imagine a very rich guy with a large mortgage gets fired from his job. Therefore, you don't want this number to be too high. Apple's total liabilities were $258 billion, and its total equity was $107 billion. But this seems a little high. Is Apple really this levered? So while this ratio doesn't discuss net liabilities, a skilled investor using this valuation technique would subtract cash-like products from liabilities, as these could be instantly used to pay back debt. When subtracting Apple's cash-like assets from its liabilities, Apple has a much healthier number. Moving on to controversial number 7. If you had asked me 4 months ago, I would have said this is a very silly ratio. Enterprise value divided by earnings before interest and tax, plus depreciation and amortization. Essentially, EBIT is that ratio that we saw on number 10, then adding depreciation and amortization. But keeping an open mind and not being stubborn is always important as an investor. I'm even going against Uncle Warren with this ratio. Warren Buffett often decries EBITDA as one of the dumbest numbers. This is from his latest annual report. He says, too often, their presentations feature adjusted EBITDA, a measure that redefines earnings to exclude a variety of all-to-real costs. However, let me tell you what is cool about adjusted EBITDA. Multiples are tracked on various sites such as this one. For example, Buffett doesn't like EBITDA as it excludes depreciation, which I agree is a very real expense. But then the market likely gives these companies low multiples because they have less cash flow. See, if you spend a lot of money on new capital, then your industry should have a lower multiple. For example, look at the multiple difference between coal companies, which have a high capex, and soft drinks. As an investor, using this ratio can give you a quick look on whether a stock is worth researching further. And since this saves you a lot of time in the long run, since you can't read all the annual reports of every stock, you need some arbitrary way to filter down your list. Unlike the PE ratio, which will be discussed later, what I like about the EV ratio, enterprise value, is that it includes debt and cash, and EBITDA is before interest and debt payments. So essentially, EV to EBITDA is a view from the top of the mountain. What this means is you see the whole business and you don't get caught up in the trees, such as the business having a high amount of debt or it's spending a lot on a future growth project. This ratio is independent of a firm's financial structure and growth plans. Let's do an example. Enterprise value is calculated as the market cap of equity plus all types of debt less cash. We include the $12 billion and $9 billion, the $94 billion term debt. Then we minus out the cash and cash-like products of 25, 40, and 170 billion. The reason cash is negated is because the cash can be used to buy back debt if Apple so choose. The EBITDA is first calculated by finding the EBIT of operating income, plus depreciation, which can be found in the company's cash flow statement. Taking this all together, 871 divided by 83 produces an EBITDA of 10.4. You can then compare Apple to its sector from the website before. This saves time and gives a quick way to filter new ideas. Moving on to number 6. You probably have heard of this one. This is the best ratio to use for beginners because it's one of the simplest financial ratios. The reason this isn't number 1 is because it's great for a beginner, but you need to know more than the PE ratio if you want to beat the market. This ratio tells us how much earnings we made as a shareholder this year and how many years in the future it would take to be paid back, assuming no growth. Apple's share price is $211, and its diluted EPS is $11.91. The reason that you use diluted is that it includes people who are not yet shareholders but have the option to buy Apple stock. Apple's PE ratio is 17.6. This means assuming no growth, it would take 17.6 years to get back all your money. This gives you a good quick snapshot in determining whether you should dig further into Apple's results. Since Apple's PE is below the market, it's a positive sign, so keep digging. Okay, from 6 to 10, we got those easier ratios out of the way. But now you want to generate, as people in the industry say, alpha, which is a fancy word meaning beat the market. Let's move on to number 5. The reinvestment ratio is a more advanced ratio, but one of the most important things for an investor to determine in understanding a company's growth rate. If a company reinvests all its profits back into the company, then you would expect higher growth, right? In fact, Uncle Warren has said this many times. Here's an example. Take an $1,000 bond with an interest rate of 4%. Then you would make $40 a year. Simple, right? But what if you reinvested that $40 in a new bond at 4%? The next year you would make $41.6, or a growth of 4%. Buffett felt that reinvesting all the cash flows and earning the same return isn't that exceptional. Let's compare it to a company that pays all its net income in dividends rather than reinvesting it. See, they now have 0% growth. So is the first management really smart and the second one really dumb? This is why you need to track what is reinvested. Let's do a calculation. Net CapEx is capital expenditures minus depreciation. Net working capital in the most simple form is the change in current assets minus change in current liabilities. Operating income, we already discussed. Then we can minus out the taxes. We can see Apple is a little weird because it has so much power over its suppliers. It actually had negative reinvestment in 2018. This is truly an amazing number. Let's move on to the 4th most important ratio in finance. Earnings per share is a simpler ratio, but it's very important for you to conceptualize as a shareholder. Let's say you own 1 share of Apple, and Apple earned $59 billion last year, and it had 5 billion shares. That means you yourself with that 1 share earned actually $12. While this doesn't mean you can walk into the Apple store and take $12 out of their cash register, but as a shareholder, it means that you actually realistically earn that $12. It's important to understand this as a shareholder because you should think of yourself as a business owner, not someone who owns Apple stock that's worth around $211. Okay, we are getting close to number 1, and these ratios are getting more important as we move down the list. Moving on to number 3, we're going to look at organic revenue growth. Organic revenue growth is just the current year's revenue less revenue acquired in the current year from acquisitions. Then it is divided by the prior year's total revenue. As can be seen, relative to Apple's size, it essentially made no acquisitions in 2018 or 2017. So we don't need to consider how acquisitions affected its revenue. But for other companies, you may want to look at the cash flow statement to see if any adjustments need to be made. You could make a minor adjustment if you really wanted to, but I won't, as it's not worth the time. So it can be seen Apple grew organic revenue by 16%. This is very healthy. Seeing this can better help you forecast future years' growth. And let's move on to the second most important ratio. A similar idea to number 3, but this time we're only looking at operating income. As revenue is great, but as a shareholder, we actually want profit. Similar to the ratio before, you should find acquisition operating income and subtract it from the current year. Since Apple basically had no acquisitions, we can just compare this year versus last year. And like revenue, Apple grew operating income at a very healthy 16%. Okay, in order to see number 1, you need to head over to our Patreon. Just kidding. And number 1 is return on invested capital, which is operating income after taxes divided by what shareholders and debt holders put up. This is important as someone buying the business would want to see what they could earn irrespective of how much debt you use. Some companies make high return for shareholders because they use large amounts of leverage. Leverage can be good, but it's not so impressive to make a higher return on equity from leverage. In fact, it's easy to do so. So ROIC shows how management did without leverage. Let's do the calculation. So this means there's a total base of $129 billion of debt plus equity minus cash. Apple's ROIC is an amazing 45%. People in the industry love this ratio, and you should consider using it too. Guys, if you enjoyed this video, let us know with a thumbs up. This tells us to make more educational videos like this, and please subscribe to our channel.